Okay, so today we're going to do interpretation. We did cash flow, so I'm not going to touch on it. We did cash flow, so yeah. And then let's start with 5.1 because I want you to also be able to answer this kind of question. So choose a term from the list below that answers the specific following questions. Write only the term next to the question numbers 5.1.1.1 to 5.1.5 in the answer book, right? There's gearing, there's return on equity, there's solvency, there's liquidity, and there's profitability. 5.1.1 is the business able to pay off all its debts. So this has to do with liquidity. So liquidity has to do with the business being able to pay off its short-term debt. So this is liquidity, right? And then 5.1.2, can the business pay off short-term debts? No, pay off, is the business able to pay off all its debts? All its debts is solvent. All of the debts is solvent. I'm sorry. It's solvent. Yes, it's solvent. Right. And then can the business pay off short-term debts in the next financial year? That's liquidity. So we're going to write liquidity. And then will shareholders be satisfied with the benefit that they receive for investing in the company? That's return on equity. Return on equity. And then 5.1.4, to what extent is the company financed by loans or borrowed capital? That has to do with gearing. Right. So it's important for you to understand these things. It's important for you to understand these things. And the ratios are linked to them. If you can listen to the lesson on it, you can be able to do it. Okay, so then we move to 5.1.2 has to do with what? Yes, 5.2, the thing that has to do with ratio is 5.2.4 and 5.2.5. 5.2.4, calculate the following financial indicators on 28 February 2019. Asset test ratio, debt equity ratio, return on average shareholders equity. Return on average shareholders equity. Right. 5.2.4. 5.2.4, yes. Asset test ratio. Asset test ratio, I told you that it's current assets minus inventory is to liabilities. So let's go look for this numbers information. So it's under the determining financial position, current assets. Current assets will have, they said for 2019, so only for 2019. For 2019, we have 996,480. But then we have to less inventories, which is close to 448,000. Is to current liabilities, which is 553,600. Right, and then the ratio is equals to, do the calculation here, 480 minus 448,000 divided by 553,600. So it is 0.1. It's 0.1. is 0.99. I feel like that's one. That's 1:1 because it was like 0.99. That's 1. So 1:1. And then we have to do the debt equity ratio. So non-current liabilities of equity. Where is it? Non-current liabilities is the loan home bank. So it will be 1,400,000 is to equal to. There's nothing on equities here, which means we're supposed to calculate it, I think. So that's it. It was supposed to be calculated. So you have to do the entire equation. Ah, okay. Let me see if I can get it very fast. Debt equity. So we got the debt, but we don't have the equity. Just have to get the equity, and the equity has to do with share capital. There were 900,000 issued on 1 March. That has to be the beginning additional we issued when the company repurchased the share, the average share price at the time. So now we have to calculate the total equity, and equity consists of share capital and retained earnings. So our share capital, we have to find the average. The average. So at the beginning, they're saying that there were 900,000 shares. Let's say at how much at the beginning of the year? Ordinary share capital. Oh, what we do not have is the retained income. And I saw up they were supposed to do a retained income or whatever, which I don't have time for. But then to calculate this, you're supposed to take a 1,500,000 and whatever amount that was bought on retained income and put it here, and then you would get the ratio. So calculations are really, really simple. Return on average shareholder equity. So you're going to, also this one will also need the retained income. So please note that they said average shareholder equity. So you're going to take the return is the net profit for the year, and then you divide by the average. So you're going to take the one for last year, the total equity for last year, and the total equity for this year, add them together, divide them by 2, and just and then just take net profit and divide by the number that you get, and then multiply by 100, you get the amount. That's what you're supposed to do, right? And I can do that without the retained whatever amount. And then 5.2.2, 5.2.5, let's move. Calculations are simple. I can even open the solution if I want to see it, because I don't have the retained whatever amount. Those are the connected. Okay. The shareholders are satisfied with the improvement in the liquidity position. Quote 3 financial indicators with figures to support the statement. Liquidity. Let's go today. I think this was given. So when we talk about liquidity, we're going to look at acid test ratio. We're going to look at we're also going to look at acid test ratio. We're going to look at current ratio, acid test ratio that was calculated up there, and then we're also going to look at status collection period. That also has to do with liquidity. The reason why it is important, the debtors collection period, the financial indicators, right? They said code. So you don't only have to list them, you have to code, right? So we're going to start with acid test ratio. The acid test ratio. The acid test ratio. So commenting is important. So it was 0.4:1. It improved from 0.4:1 in 2018. I'm sorry. Hello. Mfukeni minjani? Oh. Niko. Tiko. Tiko. It did. All right. Sure. To 2019, it improved from 0.1 in 2018, and then to 0 to 1:1 in 2019, right? So you have to show that, so you'll get the mark for saying that is the acid test ratio and saying that it improved from whatever to whatever, right? And then another thing is the debtors collection period. Debtors collection period. Debtors collection period, in 2018 it was 39 days, and then in 28 days, and then in 2019 it was 28 days. So it also improved. You can also say that the debtors collection period improved from 39 days in 2018 to 28 days in 2019. This means that debtors paid us faster. So debtors collection period just shows that the number of days that debtors were paying us. So in 2018 it was 39 days, and then in 2019 it was 28 days. Hello. Nisanda ka number ay? All right, sir. I'm sorry about that. It's this time of running a lot of businesses. Sorry, it's another client. Just going to send them my location on WhatsApp because they want to come. I'm sorry. Okay, I'm sorry. So the debtors collection period also improved because we want our debtors to pay us as fast as they can. So it improves because in 2018 it was 39 days, and then this, like right now in 2019, it's 28 days, right? So we're also going to incorporate the current ratio. Current ratio was 0.7:1 in 2018. It also improved to 1.8:1 in 2019, which means that right now we are in a better position than we were last year. And then another ratio that you can look at when you're dealing with liquidity is creditors payment period. We want the dates for creditors to be high, right? Because we want to pay our creditors a little bit later as we're collecting money from our debtors, because paying needs cash flow, needs cash, right? And sometimes we don't have cash because we're selling on credit and all those kind of stuff. So the creditors payment period didn't change. It was 60 days, it's still 60 days. So there's nothing more you can say about that, but you can use current ratio, exit test ratio, and the test collection period and get your 6 marks. So that's important. I'll also try to share with you the memorandum so that you can see what they came up with. And then another thing that you can do is that 5.2.6, the company increased the share capital by, explain how this affected the gearing risk, a gearing and risk of the company, code 2 financial indicators. So when we're dealing with gearing risk of the company, this has to do with debt, right? Debt, and debt, we're talking about long-term debt. So you're going to look at return on total capital employed, and you're going to look at debt equity ratio. All right, we're not able to calculate the debt equity ratio, but then the return on capital employed was given to us, right? So the return on capital employed in 2019, in 2018, it was 14.4%, and then in 2019, it's 12.9%, right? And then the interest rate stayed the same. So anything that has to do with that, right? You have to look at it, right? So the company increased share capital by 840,000 and the loan by 550,000. How did it affect the gearing risk of the company? You use debt equity ratio, you check how it is. Did it improve or what happened? Did it go higher or not, right? And then you also, like I told you, return on capital employed. Return on capital employed decreased from last year. So this is actually bad. Return on capital employed decreased, which is bad, right? So we don't know how the debt equity ratio is, but yeah, that's what it's basically about. So you have to know which one is for what. You have to know which indicators are for gearing, and gearing has to do with that, right? And you have to know which one has to do with liquidity. You have to know which one has to do with profitability. I'll try sending a document to you that will help you to understand what is what, because I think it's important. When I send this, I'll also send it through. And then we move. You see there are a lot of marks there. You get 2 indicators. You say if they increase or decrease, you get a mark, and then you conclude. You explain how it affected the company. What did it affect the company in a bad or a good way? You get all your 5 marks, right? Explain what the indicators have done with this cash. Explain what the directors have done with this cash flow. Say 2 points, right? So you have to check that the cash inflow that came into the business in terms of the loan and the issue of shares, what did they do with it? And here you're going to look if they bought new assets. Those are the things that you should look at. Did they buy new assets, or did they issue more dividends this year? So you have to check for that, the cash flows. But you're going to find this under investing activities or the cash flow. You're going to find this under investing activities on the cash flow statement, the answer to this question. But this is very simple. You just have to like apply. And then there's other things that I cannot see here. Let me go check on the questions here, because this answer sheet cut some stuff. The directors decided to decrease the dividend payout percentage, provide calculations to show the change in the payout rate, give one reason why many shareholders were satisfied with the change in policy, quote figures, right? So the director decided to decrease the dividend payout percentage. Now you have to calculate the dividend payout percentage. And to calculate this, you can use, we have dividends per share, right? Dividends per share in 2018 was 80 cents. And right now they are 47 cents. So to calculate the payout ratio, you take dividends per share and divide it by the earnings per share. So for last year, you take 80 cents over 83 cents, you get the payout ratio. And then you take, let me just show you. To show the change, right? In 2018, we had, so the dividends per share was 80 cents, while the times 100, right? While the earnings per share was 83. So 80, we want to find the percentage. 80 divided by 83 times 100 in 96%. That was 96%, which means that last year we paid what? We paid a lot more, right? We paid a lot more. We paid 96% of everything that we earned, right? And in 2019, the dividends per share was 47 over 71, right? Times 100. 47 over 71 times 100. It's 66%, right? So it decreased from 96% to 66%. And give one reason why the shareholders were satisfied with this, right? You also have to write down here that it increased from the dividend payout ratio increased from decreased from 96 to 66%, and explain why the shareholders are happy, right, with the change in the policy, right? So what you're going to look at is the return on shareholders. You might have to calculate the return on shareholders, which we're supposed to calculate. So you're going to take the amount that whatever. So if it shows that the return on shareholders increased, it's a good thing. That could make the shareholders to be happy. Another thing, you can also check the market value per share. All right. If the market value increased like it did right now, it was 807 cents, and then it increased to 840 cents. So this shows an increase. So you're also going to show that, right? And then yeah, you get marks for it. Let me see if there's still anything else that we can look at. No. Okay. On 1 March, Martha owned 475 shares in the company. She did not purchase any shares from the shares issued on. Explain how the repurchase of the shares benefited Martha's shareholding. So Martha, right? She had at the beginning, beginning, right? At the beginning, Martha had what? 475,000 shares, right? 175 shares. And then what were the total number of shares issued? There were 900,000 shares, right? Times 100. So now we want to find out the percentage that she was owning the company. So 475,000 divided by 900,000. 900,000 times 100. And then Martha was owning 53%, right, of the company at the beginning. And then we had after the issue. Because they issued shares, right? So after they issued additional 100,000, and Martha did not what? Did not buy any of the shares which were issued. So now it means that, so now we're going to calculate how much she owned of the company after the issue of 100 times 100. And then we get how much? I want to see the answer. 475,000 divided by 1 million. Because now we had 1 million shares, right? Times 100. So now Martha only owned what? 48%. 48%, right? And then we go to the after repurchase. After repurchase, so now we have 475,000. How many shares were repurchased? 60,000, which means now we have only 940,000 shares in issue, right? Times 100. So 475,000 divided by 940,000 times 100. That's 51%. 51%. So these are the calculations that you have to make, right? And you're going to get marks for this, right? So the question is, explain how the repurchase of the shares benefited Martha's shareholding. Quote figures. These are the figures that you're supposed to quote, right? So initially at the beginning, what happened? Martha was owning 53% of the company. Anything more than 50%, it means that Martha was controlling the company. Martha had control over the company because she was they call it a major shareholder, a majority shareholder. She had most of the shares, right? She had 53%. And then after the issue, now Martha owns what? 48%, which means now she's no longer in control. She's no longer the majority because that's below 50%. And then after the repurchase, again, now that Martha owns 51%, which puts her back in control. So she was happy because now she was the majority shareholder again. That's all you have to show. That's all you have to write. And then you'll be done, right? And then you get your 4 marks. You're done. So you see all the marks that I was telling you, like you just have to use your logic. So that's the thought that you have to use when you're, because I'm telling you, most of the marks will come out of what? Of the commenting rather than the calculations. Yes, calculations would have some marks, but mostly they want to see. You have to like take all the marks. You can see there are a lot of marks, a lot of marks that you're supposed to get. Only if you knew what you had to do, only if you knew your work. And then please remind me if I forget to send you the one that classifies this under liquidity profitability of what they explain. So this will be the end of our class, and I hope you have a great night. I hope you enjoy this. We're done for today, and then let's meet again next week. Yes, and I hope that you did the work because you didn't submit. I don't know if you did it or you didn't, but yeah. So we are going to go over what? We have to go over the audit report. We have to go, I had forgotten about it, but we have to go over the audit report sometime next week, or I don't know, because I wanted us that by the end of next week we start with the real stuff. We start with term 2 work. We have to start with term 2 work because we have to finish term 2 work, and after term 2, greater will start. So yeah, I hope you understood, and if you don't understand anything, you talk to